So, good evening, everyone from everywhere you are listening to me. Welcome to another session of tutorials. We are kickstarting right away. Please, if you can hear me, just give me a thumbs up and then we'll kickstart as quickly as we can. Thank you so much. Apologies that we've not been able to meet all along. I've been a bit very out of schedule and apologies for that though. So, let's quickly go. Tonight, we begin with group account, that is consolidation of financial statement, what most of you will know now you call the group account. That's what we are looking at beginning tonight. We also have about 3 classes, and I believe you will be grounded with it. And so the major standard that we are going to consider includes the IFRS 10, and then that of IFRS 3. IFRS 10 talks about consolidation of financial statement. IFRS 3 talks about business combinations. And then another standard, of course, which we have also considered is that of IAS 13, that is fair value measurement. We have looked at it together in the previous classes, and that talks about fair value measurement. We have been able to look at what it entails, how to go about it, and the like. So, quickly tonight, IFRS 10 talks about that once there is a parent company and that there is a subsidiary or there are subsidiaries, they are expected to consolidate their financial statement as a single entity. In other words, once you have a parent company and that parent company has subsidiary or subsidiaries as it were, it is expected that then they consolidate their financial statements as if they are a single entity. And this is why we have what we call consolidation of a financial statement. In the wisdom, however, of IFRS 3, it talks about the fact that when there is a consolidation process, we should follow certain procedures at arriving at the fair value of the net asset and liability of the subsidiary. That is, IFRS 3, which is business combination, talks about, once there is a consolidation process that is going to take place, we must be able to follow the general principles, at arriving at the fair value of the net asset and the net liability of the subsidiary. When we say the fair value of the net asset and liability, we are talking about the prevailing market price, as it were. What is obtainable in the market in terms of the asset and the liability of a subsidiary. In other words, once a parent is about to acquire or it has acquired an entity, there is a subsidiary. It implies that for you to prepare your consolidation financial statement, IFRS 3 gives us certain procedures that we must consider in arriving at the net asset and the net liability of that subsidiary, as it were. And then it gives us a procedure which we shall look at in this class put together. So, by way of definition also, we begin with exactly what is a parent company, what is a subsidiary company. Now, this is where to begin from. If you have the understanding of it, it helps you to be able to, handle any life situation that comes across of you. So, what is a parent company? A parent company simply means a company that have a control over another entity. A company that have control over another entity. The question now again is, what is the control? The control simply means that the entity has the power to direct, to dictate, to influence the decision of the entity, as it were. And but then for this to take place, let me go back again. For control to be in place, it means that the entity has what we call the power to influence, to direct, to dictate the affairs and the activity of the other company. And for this to take effect, it simply means that that entity must have what we call above 50% stake in that entity. In other words, let's assume that company A has control over company B. For us to ascertain that that company A have control over company B, that company A must have more than 50%, that is 51%, let's just say 51% and above, shareholding out of the entire structure or the stake that an entity has. That company A must have 51% stake in that company B for us to say there is a control. So that is that for that. And once an entity have over 51% in an entity, that company is known as the parent company, and in that company has the 51% is known as the subsidiary. Where an entity have what we call 50% in another entity, that control is not a full control, but rather it is known as what we call joint controls. It is known as what? Joint controls. In other words, if company have 50% stake in another entity, we can't say that that company have full control over that entity. Rather, it has what we call a joint control. And that is why we have what we call the joint venture. At your level now, you will not be looking at joint ventures. When you go to the professional level, you will look at it and associate also. At your level, you are just to know the parent and then the subsidiary as it were. And so a subsidiary is a company that has a parent company that is has another entity that has the power to control, to dictate, to determine, to direct its affair as it is it deems fit as it were. So parents are those that have over 51% stake in an entity, or let's just say 50.001 and above, like that. Once you have it, so you have controls over the entity as it were, while the subsidiary remains the one that the other company has control over. It's as simple as that. And so now we have established this definition, and I'm sure you understand it. Before we proceed, do you have any question? It's important that I hear you speak. You have any question, please let me know. Can you still hear me, please? If you can hear me, just give me a thumbs up. Okay, please, no question, I can go ahead. Just let me know. Okay. All right, so let's go. Now, when we talk about consolidation of financial statement, you need to understand, like I've explained, it is what we call preparation and presentation. That is a combination of all, information of another entity into a single entity as it were. So that is that for that. So quickly, what are the types of consolidation that you are expected to do? The types of consolidation that you are expected to do. Number one, we have 4 main types of consolidation in terms of financial statement. That is, 4 types of financial statement that you must consolidate. And remember, when I say consolidation, I have explained it earlier. The simple meaning, the literary meaning is that you are combining the financial statement of parent and subsidiary or subsidiaries into a single entity financial statement. In other words, you are preparing and presenting the financial statement of both the parent and the subsidiary or subsidiaries as if they were a single entity. And the reason is simple. It is important for users to be able to know exactly what parent company is into. This will help them to also make some informed decision. That is why we prepare what we call a single account when there is a subsisting parent and the subsidiary. So 4 main types of account, or 4 main type of statement that you are to consolidate, and you are to learn how to consolidate. And number 1, the statement of financial position. You must learn how to consolidate the statement of financial position. You must learn how to consolidate statement of profit or loss and other comprehensive income. That's number 2. Number 3, you must learn to consolidate statement of changes in equity. Please be writing. It's important you write. And number 4, you must learn how to consolidate statement of cash flows. All of these statements are very, very simple to consolidate. They are very, very, very simple. Consolidation of a financial statement is the most simplest in all of in all of the FR courses that you will be going through. Very, very simple. Eh? People make it to look hard, but I will tell you it's very simple. Just understand the basics. You run through it, you can deal with it at your pace anytime, any day. You understand now? So let's quickly run through something that I've put down here, like I've said. The 4 major statements that you must learn how to consolidate: statement of financial position, statement of profit or loss, statement of changes in equity, and statement of cash flow. We are going to do it in this class. I will not rush you at all. We'll take it very slowly, very, very slowly. And then I'm hopeful that within these next 2 weeks, we should be grounded and we should be done with it on a final note and get you prepared for your exams. So these are the procedures that you need to know. These are the key 4 major procedures that you need to note. Number 1, you are only going to combine like items. Like items. In other words, you combine the asset of the subsidiary with that of the parent. You combine the liability of the parent with that of the subsidiary. You don't combine asset of subsidiary with the liability of parent. You don't combine asset of subsidiary with equity of the parent. You combine like items in both of the entities. You understand me now? So asset of parent is combined with that of subsidiary. Liability of the parent is combined with that of the subsidiary. Equity as well as other items are also done, other elements rather, are also done in that same manner. That is the first thing you must know. Asset to asset, liability to liability. You understand me now? That's how to do it. Number 2, you must eliminate the investment status in both entities. When you are consolidating, there is nothing like investment in associate or investment in investment in subsidiary that must appear in any of your financial statements. You must eliminate that investment, and that we will look at when we are doing the calculations. You must eliminate all the investment status. Number 3, you must eliminate in full intergroup flows of asset, liability, income, expense, and cash flow. That is, all the flow. Take for instance, they say parent carry one asset and give to subsidiary. You must learn how to eliminate it completely. They say parent A give to the subsidiary a car for use. That one is not, we don't consider it. It's not considerable. So anything that has to do with asset, liability, income, expense, and cash flow movement, they are fully eliminated. And then number 4, you must fully eliminate what we call profit or loss arising from intergroup transactions. Intergroup transactions means transactions between the parent and the subsidiary, or subsidiary and the parent. And so therefore, the profit or loss that is made must be fully eliminated. You will learn all of these as you proceed, but bear this in mind. These are the 4 things that you must keep in your mind. You combine like items, eliminate investment status, eliminate any intragroup movement of asset, liability, that is the element of financial statement, eliminate them in full. And then number 4, eliminate in full every profit or loss arising from intergroup transactions. Very, very important. And that is that for that. So now we are going to begin with how to calculate or consolidate the statement of financial position. Once we are able to get right with the statement of financial position consolidation, All of that ones are very, very simple. This one, I'm going to break the statement of financial position class into two. I will only give you the basic steps. You understand me now? And that is that for that. Now, what I used to tell my students that I've always make them to pass group account is this. There are 8 steps that you must follow. Let me divide to two. 2 steps that you must follow. 2 steps that you must follow. Oh God.